Good morning, everyone, and welcome to our virtual panel. My name is Emily Hassig, and I'm the Chief Development Officer at Promises2Kids. And this is the third installment of Promises2Kids Presents as part of our Promising Futures Legacy Circle initiative, where you can show your longtime commitment to creating a brighter future for foster children through legacy planning. We will be discussing today tax changes for 2022 and beyond, as legislation changes and how they affect you personally are on top of everybody's mind right now. And so it is with great pleasure that I'm happy to introduce you to our panelists. Patty Mayer is a CPA and director at Moss Adams, where she serves as the leader of the Southern California not-for-profit tax practice. Patty provides tax and tax planning services predominantly with public charities, private foundations, and tribal organizations. Welcome, Patty.
Thank you.
Brett Pernicano is a lead advisor and principal at Dowling & Yankee. He works closely with his clients on asset management and comprehensive financial planning, and his practice involves multi-generational planning and working with business owners on transition strategies. Brett is also a member of the Promises2Kids Board of Directors. Welcome, Brett. And finally, we have Danielle Humphries, who's a partner at Hahn Lozier & Parks, and she is chair of the Trust and Estate Practice Group in the San Diego office. Her practice focuses on estate planning, wealth transfer, probate, and probate litigation. Danielle is also a member of the Promises2Kids Board of Directors and will serve as moderator for today's panel. So with that, I will let Danielle kick off today's discussion.
Thank you, Emily. Thank you, everyone, for joining us. We had hoped that this presentation would be in person, so now the hope is that this will be the last virtual presentation in this series. One of the things that I, as the attorney, just want to say before we get started is that today we're going to cover a variety of topics, and the information that we're providing is intended to be educational, hopefully very informative to all of you. We are available to answer questions after. All you need to do is talk to Emily, and she can put you in touch with any one of us if you have questions or would like a further discussion on a particular topic. But for purposes of this presentation, we are not providing any legal, financial, investment, or tax advice. So with that, all of you have probably seen that there is a lot of activity going on related to proposed tax changes, and it seems to change on a daily basis. It's definitely keeping all of us who are on this panel very busy watching these changes and trying to predict what direction proposed legislation is going to go. We all wish, I think, that we had a crystal ball and we knew for sure, so that we could provide our clients with some clarity about what's going to happen, and so that they can start taking action based on knowing what's going to happen with the proposed changes in the tax laws. But all we can do is educate and inform based on where things stand, and let you know what the proposed changes are. So with that, I thought I would ask Patty, what are some of the key changes to the tax laws that are being proposed? And when I say key changes that are going to affect most of us.
Yeah, sure. Well, before I answer that, I just wanted to set a little bit of background. How things are changing so much. The Senate passed their version in August of 2021, which had a lot of provisions. House Ways and Means did their version in September, and they were sometimes a little bit similar, but had a lot of information in there. Well, then last week, a new bill was redrafted, and that's the one I'm going to mainly talk about today and let you know what they've taken off the table that we thought might be impacting us. So one of the big ones that could affect a lot of people is they have expanded the net investment income tax. That's the tax, that's a 3.8% add-on tax that is applicable today and applies to taxpayers if they have income over $250,000. There's different thresholds, but it's taxing passive income, what we think about as interest, dividends, capital gains. This also is a tax that's not looking at your taxable income overall. It's looking at, so you don't get deductions for a charitable contribution to figure out your number when you're subject to this 3.8% tax. What this new proposal is doing, it's doing a couple of things. The first thing is, and it's been called the Billionaire Tax, but they're adding a surtax for high income earners, and it would be 5% if your modified income exceeds 10 million, then another 3% if it exceeds 25 million. So that's going to affect a very exclusive class of tax return filers. Where it could hit other people is they've expanded, and this is a huge change. They've expanded, when we think of passive income, okay, that makes sense, my investment income. Well, now they're bringing in ordinary income from operations. So if you're in a partnership or have income passed through to you, that was excluded before, but now that's coming in to this thing. If you are a single person with 400,000 of taxable income, you'll be affected by this. And then also married filing joint is 500,000.
Hey, Patty.
Yes.
This is Brett. Just a quick question on that. But that would also pertain to somebody that is selling a company. So if they're doing a private transaction, they may not make 25 million a year, but they have a single year where they sell their company and have a $70 million gain, that would also affect it.
Yes, absolutely. And this is effective next year, starting 1/1/22, if it does get passed. It also has a 5% tax on trusts and estates. If they don't distribute out all of their income, the trust or estate will be taxed at 5% if it exceeds 200,000. So a planning there would be, if you can distribute the income out, do it. And maybe you're okay, the beneficiaries may not be subject to it, or they're paying the tax at their level at 3.8%. Another interesting one, for corporations, for large corporations, they're adding on a 15% minimum tax. And they think this is going to be a very, very big revenue generator, where large corporations are right now able to shelter a lot of income. It's going to have very complex computations on how you figure this out. Other things to note, this did not make the bill. We were thinking they might lift the cap on SALT, state and local income tax deductions. Right now, the cap is $10,000 per year. So your state income tax, real estate taxes, things like that, withholding, it's limited to 10,000. Well, that did not, removal of that cap did not happen. Changes that the Senate and Ways and Means Committee were looking at, that it's possible it might come in the future, maybe not, but they were looking at increasing the individual tax rate, getting rid of or changing the capital gains tax rate to 25%, reducing the estate tax exemption to 5 million, and not allowing for step up in basis of assets upon death. And they had some other ones relating to Grantor Trust, pulling in, it got really technical because I don't work with a lot of trusts, but changes to Grantor Trust, that didn't happen, where you could, now you're still allowed to take discounts on certain business property, but they were going to try to take that away for transfers and gift tax things. And also they had a provision, what they called mega IRAs, that you were required to distribute IRA out and bring it into income. That did not make the list either. And those we're looking at.
Hey, Patty.
Yes.
Let me just touch on that one real quick. I literally just got an email 4 minutes ago from CNBC saying that in the new proposal that just came through, the Democrats added it back in.
Oh, for the mega IRA?
Yeah, so the $10 million threshold, that has been added back in as a required minimum distribution for above 10 million. And then they also eliminated the backdoor Roth loophole. Okay. So that was, my point is that this is like constantly moving every day. I think there's been 3 or 4 updates in the last 3 days. So we'll see more to come in the next couple of days or week or we'll see.
Yeah.
Can I ask you a
Brett,
question on that?
Thank you.
Is it okay to ask questions, or do you want to wait till the end?
No, please.
Just a question on the backdoor Roth. What was that?
So they said that, and this is just an update I just received, but that they're eliminating the loophole for the ability to do it. So my guess is they're going to put some sort of threshold in regards to being able to make that non-deductible contribution, because previously you'd make the non-deductible and convert it immediately over. And so I haven't dug into the email that I just received, but that it would close that loophole on the backdoor Roth.
Yeah, and along
Thanks.
the lines of last minute updates, I wanted to add that I received an update this morning on the SALT cap, and that there are proposals to raise it to 72,500 from the $10,000 current limitation. There's also a proposal to make it unlimited for people making under $400,000 a year. And then just to speak on the trust and estates piece a little bit, right now, I think a lot of us were surprised to see some of the trust and estates related tax law changes not in this most recent bill. It doesn't mean that they won't be added back in. And so I know that as I'm meeting with clients, we're still talking about what those proposed changes were. One of those proposed changes is already scheduled to go into effect on January 1st, 2026. But that change was taking the amount of the exclusion, the estate tax exclusion, from $11.7 million down to $5 million indexed for inflation, and doing that effective January 1st of 2022. So just accelerating the decrease in that exemption. And then the other, like Patty had mentioned, was a change to the Grantor Trust rules, which we won't get into today, the Grantor Trust and what you can do with Grantor Trust. But what's significant about it is that if you have a Grantor Trust, if you are worried about the Grantor Trust rules changing, it's something you should be speaking to your advisor about right now, because there may be a very small window for taking advantage of Grantor Trust rules. Right now, it doesn't look like we're dealing with that window, but it would not surprise me to see those items come back into the tax law changes before the end of the year.
Hey, Robert, Brett again, just to address that. Yep, it would prohibit after-tax contributions to a IRA for any income level, and that being able to convert from pre-tax to Roth would be cut off at 400,000 for for single individuals and 450 for married couples. That's proposed right now. That's just what I got.
So that would be the limit of conversions, annual conversions.
And the after-tax contribution. So being able to make a non-deductible contribution essentially would be shut off.
All right, so Patty,
okay.
I know you, Patty, I don't think you got through all of those key changes. So sorry to interrupt your flow, but do you want to resume?
Actually, that's what I did get through.
That's it. Oh, great.
Yeah.
Okay. Well, so in light of all of these changes, I just mentioned that there's some things that people are doing to take advantage of possibly expiring Grantor Trust rules, including things like selling assets to these trusts that we call defective Grantor Trusts. But what are some other things that the two of you are recommending to your clients based on these proposed changes in the tax laws to help minimize taxes this year and going forward? Brent, how about you?
Yeah, so I think one of the things that we've talked about is IRAs right now. And an area that I find probably very limited conversation about over the last couple of years is something called a qualified charitable distribution. And so what it means is if you have an IRA and you are of age where you have to take a required minimum distribution, so you actually have to take money from the account so that the government gets their tax dollars, right? Whatever distribution you take from a pre-tax IRA, traditional IRA, you pay income taxes on. There's something called a qualified charitable distribution where you can take a portion of that required minimum distribution from your IRA and you can give it directly to charity, and you can do up to $100,000 a year. And what that allows you to do is bypass the income tax liability on that. So here's an example. Somebody wants to make a $10,000 contribution to a charity. They can take, let's just say for hypothetical purposes, that they have an IRA and they're required by tax law to take a distribution of 50,000 in a calendar year in 2021. They can give 10,000 of that 50 directly to charity. And then when they do their taxes at the end of the year, if they have a CPA or they do it themselves, they get to not take into account that 10,000 for income tax purposes. So it's a great way to give directly to charity and bypass the income tax liability for that distribution from your IRA. If you think about it in a hierarchy of most powerful impact with regards to tax savings, as well as making a charitable contribution, it's the top, because you get a direct charitable contribution and you don't have to pay income tax on that. So very powerful. I'm following the IRA stuff because we do have clients, and it may not be you directly. It may be a parent of yours that has an IRA that they have to take RMDs on, but they're charitably inclined. Being able to give a portion or all of their RMD directly to charity is a very, very powerful tax tool, and not having to pay income tax is great. So that's one of the ones that I think we don't talk about enough, but it's a very powerful one. And then in light of some of the tax changes that we've discussed in regards to capital gains, if that were to happen, I think they set the date as September 13th, but if between September 13th and the end of the year, there are assets that you, for example, stock that you have that's appreciated that you were planning on selling and giving money to charity, it's more advantageous to give appreciated stock, which I'm going to talk about in a little bit, but that is applicable to some of the increased capital gains rates where people want to get a better bang for their buck in regards to charitable contributions.
Yeah, thanks, Brett. I wanted to add on to Brett's comment about Ira Distributions. You can go up to $100,000 per year that can go to a charity. And then also you don't get to deduct a charitable contribution because you've taken the deduction by not bringing it into income. So that would be double dipping. And then be careful on who you're giving it to. I think most investment companies know the rules, but it can go to public charities, not private foundations, and not donor advised funds. It can go to some funds set up maybe at a community foundation, but you want to make sure it's not in what's called a donor advised fund. It could be maybe in a scholarship fund, but you don't have control. You could be on a committee to designate recipients, but you wouldn't be able to just on your own make a decision.
So what happens on that is when Schwab or Fidelity or whoever your custodian is that you choose, if you have an IRA with them, when you say you want to donate to charity, you'll typically have to fill out a form with them. And they have a process with just saying, is this a valid, to your point, Patty, is this a valid, 501c3? And they will help directly cut the check to that charity. So they'll have a process where you'll sign a form and you say, I want $10,000 sent directly to charity. And so they'll work in the kind of logistics side of getting that completed. So it's all able to be tracked for tax purposes. Some IRAs allow you check writing ability. So you just need to know that has to be cleared before end of the year.
So I have a question either one of you can answer. So what if you take out your RMD December 1, you take out the whole thing and put it into your bank account, and now you want to make this gift of $10,000 using Brett's example of a $50,000 RMD. Now you want to make your $10,000 gift to charity.
That's something I'd have to talk to Schwab about.
Patty,
you could theoretically consider that a rollover and put the money back in potentially. and then do it, but it depends on what the custodian will allow.
Yeah, I don't know if that's allowed myself either off the top of my
Yeah.
head.
Yeah, I don't know the answer to it either, but I guess what I would tell people is check before you take out that RMD and make sure you're doing it right, because just by the fact that the three of us don't know the answer to that question suggests that there could be an issue and you may not qualify to exclude that portion from your taxable income.
You know what, hey,
Good
Danielle,
question.
that touches on a really good point. I think, you know, at the beginning of every year, not the end, at the beginning of every year, I highly suggest those that are planning on making gifts, and I know things change throughout the year, but to sit down with their advisors and put a plan together on which assets we will look to give, what timing we want to give them, because to that point, we have had clients take RMDs and not be able to reverse them out. And it's unfortunate because they weren't aware of the ability to do that until after the fact. And so really being strategic with what your planned giving will be for a calendar year, start that in January, February, and maybe even the year before to say, you know, we want to give 20 or 30,000 to charities, number of charities. How do we do this most tax efficiently given our assets to choose from?
Great. So Patty mentioned another concept. She mentioned a donor advised fund. What can you tell us about, donor advised funds and opportunities for giving with donor advised funds?
Okay, sure, I'll take that one. So a donor advised fund, it's set up by a sponsoring organization. You can go to a community foundation, they have it, they tend to serve the community that you're in. You can also go to the big ones like Schwab Fund, Fidelity, they also maintain donor advised funds. But basically it depends, you have an agreement with the sponsoring organization. They may have minimum thresholds for you to establish a fund, but you can contribute property, cash, whatever they're accepting, and you get a fair market value deduction for public stock and things. So if you contribute public stock, it depends what they're going to accept. But now in the donor advised fund, you've got an immediate charitable deduction. And under current law, you decide, or it could depend upon your agreement with the sponsoring organization. They could have a requirement that they want 5% payout every year. Some may be silent, that's more common right now, but you advise where the money should go. So you don't have to distribute it all out to the charity. You can distribute it over time. So this is a good example where Brett brought up, you sold your company and you have this huge gain that now you're subject to this extra tax. Well, you can help reduce your taxable income overall if you made a big contribution to a donor advised fund, but you didn't. It's great when you don't know what charity you want to receive all this money. So it's a good way to park money, get the deduction, and then maybe you don't make charitable contributions for a few years. You're just advising where you want your money to go. So they're a really great vehicle. There are some tax bills that are going to require, if your donor advised fund is over $1 million and you're at a community foundation, you would have a 5% payout, or it has to be paid within 15 years. They've kind of looked at, because a private foundation has payout requirements. It's a different type of 501c3 nonprofit. Donor advised funds don't really have that right now. So they might, that could be enacted as well.
So Brett, are you seeing clients use a lot of donor advised funds right now?
I think when the SALT cap was enacted, I think they became a lot more popular, purely because in California, that was a very powerful tax deduction. And when it went away, some people that were making $3,000 or $5,000 charitable gifts weren't getting the same power or impact from a deduction side. So I think the idea of using a donor advised fund to kind of front load giving became a very popular tool. And what I mean by that is if somebody were to to give $10,000 a year for 5 years, they would use a donor advised fund to give $50,000 to a donor advised fund, get the charitable deduction in that current year. And then, so for tax purposes, they're getting the advantage in 1 year versus giving it every year. So I found that became a very popular tool. But I think for those that want to, another would be somebody that has a big liquidity event, or somebody that is having a big tax year from gains perspective. Maybe they sold a piece of property and they said, we want to get a big tax benefit. They'll use a donor advised fund, because the flexibility of being able to give it in the future to multiple charities at different times was something that people enjoyed the ability to do. So I think there's been a lot of discussion about donor advised funds over the last couple of years. And maybe that's part of the rise in popularity. But they are very flexible. And Schwab and Fidelity and some of the big custodians have plans that are very easy to utilize.
So what about other ways of minimizing your income tax this year that entail a philanthropic element? I get asked this question a lot by people. Should I give cash? Should I give stock? Which one's better to give to? And how do I get a bigger deduction?
Can I use the term of the attorney that it depends?
Yes.
Patty, I'll let you kick it off, because I think we can talk together on this one.
Yeah, sure. I just wanted to point out there is one thing that's available through 2021 are cash gifts to charities. They look at your adjusted gross income, and cash right now, up to 60% of your adjusted gross income could go to a charity. Through 2021, there's no limit. It's 100% of your adjusted gross income. So that could be a way, if you do want to reduce your taxable income, you're not limited in those regards. And then if you're not an itemizer, you can deduct up to $600 if you're married filing joint for cash contributions, or $300 if you're single. But yeah, I think appreciated stock is a really good favorite. That one has a 30% adjusted gross income limitation, but a lot of people, they may not be affected by that. But you're not bringing the income to your return, paying tax on it, and then gifting it out. You bypass that and get a market value deduction. So that's a beautiful thing. They still have that there. Brett, do you want to add on?
Yeah, I mean, I think it kind of gets back to my comment earlier about strategy. When somebody says they want to give a certain amount of dollars to a charity, or they have an idea of what they want to give, then you get into, well, what's the best thing to give, and where is it best to come from? And I think that's a really good point, Patty, because it may be that you inherited stock 25 years ago that has almost a no cost basis, and the entire gain in the stock is subject to capital gains tax. And that getting it out of the portfolio for tax purposes, but also risk purposes, is actually very advantageous. And if your income is high enough, the deduction may be the same as making a cash gift. So it really is dependent on what the goal is of the client, and how we can integrate both the taxes as well as maybe even risk in a portfolio. There's a number of clients that may have concentrated stock that has a very low basis that we're trying to reduce risk. And so you can use charitable giving as a means to reallocate a portfolio and try to take risk off the table. If we've had a very strong run in the stock market the last since March of last year. And so there are people that bought stock in March and April last year that have significant gains. And we know that the capital gains rate may get impacted. And so for some people, trying to mitigate those gains is important. So it definitely is one thing that I work with the CPA on, and I think everyone should, is have the advisor and CPA in the same room in regards to what their charitable intent is for that calendar year.
Yeah, and then also to be aware if you are subject to limitations because of your adjusted gross income. Cash contributions, we're clear on that for this year, no limitations. But when you start mixing different things, it's a stacking, and you want to make sure you're getting a full deduction. If you don't get to deduct it, it's allowed as a carry forward for 5 years. but we don't want you to be disappointed if you thought you'd get the whole thing. So I think I agree with Brett, work with both your CPA and investment advisor to help come up with a strategy.
And since
Yeah.
we're still talking about, Danielle, real quick on this, Robert O'Connell asked about the IRA distributions and 401k distributions. If you, the qualified charitable distribution does not include 401ks, so employer sponsored plan are not under that. And you cannot, it's for an RMD, a required minimum distribution, Robert. So it must be part of the RMD. If it's pre 72 years old, you don't get the benefit of that. It has to be post 72 years old RMDs.
Okay, thanks. Because I was just following, Rob answered my question, and I was just following up if I can convert the 401k to an IRA and then do it. But if it still has to be RMD, then it doesn't.
Yeah.
Until 70. Okay, thank you.
Welcome.
So here we are on November 4th, and I heard Patty and Brett both say something about talking to your investment and or tax advisors. And I bring this up because with the amount of changes that have been proposed, there are a lot of questions. There is a lot of wealth being moved around. Clients are engaging in a lot of transactions. So if you are thinking about doing anything or you want to seize upon an opportunity that may not exist next tax year, the time is now to reach out to your advisors. I think I can't emphasize that enough, and I'm sure Patty and Brett would agree with me. I think probably all three of us have been asked on, December 30th, how can I get this stock to a charity, or I need to do this huge transaction, and it's generally too late at that time. So the time is now.
I would actually say one more thing, probably the first week of December, just from a logistics standpoint. If you plan on making any sort of gifts of stock, a lot of the custodians shut off around the first week of December. So you have a couple of weeks to make those 2021 gifts and then get into 2022 planning. Yeah.
So any other techniques or strategies that you're suggesting to your clients, Patty or Brett, to help minimize taxes this year?
Well, one of the things, because I work with nonprofit organizations, we have a lot of clients establishing private foundations instead of a donor advised fund. That's a pretty technical topic that we could have encompass in another roundtable that we're doing. But I have been seeing a lot of private foundations being established, more than usual.
What is the minimum amount? So when you talk about a private foundation, I think a lot of people are familiar with private foundations, maybe not the rules specific to private foundations, but generally speaking, how much money do you put into a private foundation kind of at the minimum in order for it to make sense for you and your family?
There is no income threshold to start a foundation. Some are started without even being funded. But what makes sense to me is that you're really putting in like 100 to 500,000. And then you're thinking you do want to make annual contributions and build it up, pass money out. You could train your family, but there is costs involved because you have to incorporate or create a trust. You have compliance, tax return filings, you have to keep books and records. If you're a corporation, you have to have board meetings, minutes, things like that. It sounds like a lot, but it's really not that bad. I tend to find clients that do this are entrepreneurs and they're used to making all the decisions. So they may not be as interested in a donor advised fund because you are just an advisor. You may be able to get involved and have your investment planner be involved with investments inside the donor advised fund, but you're not really calling all the shots. So I'd look at 100 to 500. That would make sense. Is what I see the most.
But with ongoing gifts, I asked just because I've heard over the years that really from from the perspective of the ongoing administrative costs, but then also the setup costs that really it doesn't make that much sense unless you're going to put in at least $1 million. So it sounds like there's a range.
There's a range because I've seen them as low as 100,000. I think 500 to $1 million makes more sense.
Mm-hmm.
But
Okay.
but usually the smaller ones, they do annual contributions as well.
Okay.
Hey Patty, as we approach year end, I actually just got this question 2 weeks ago. For a private foundation, what is the cutoff from or deadline you want to know? If somebody were to fund a private foundation in the next month or two, I know that there's a backup right now, I think with the IRS in regards to getting the tax ID or getting the information filed.
Mhm.
What is the deadline? I've heard that it's actually the tax deadline of the following year. Is that accurate?
Well, okay, that's a different question that you're asking, but I'll explain. If you wanted to set up a foundation, a very common way is to incorporate. You incorporate, at that time you get an ID number, bank account. You can fund the foundation, but you don't really have a charitable deduction until the IRS has received your application for exempt status and then approves you and makes it retroactive to the date of your incorporation.
Okay.
So when we have that going on, that happens a lot. We extend the individual return to make sure that they have tax exempt status. As a really straightforward private foundation is going to receive exempt status, you would have to be at risk. You'd want to talk obviously to your attorney and CPA, but something very, very different is going on than a typical private foundation where you may not get exempt status. But I'd say straightforward, you're going to be okay. You followed all the rules correctly. But then you do have the backlog with the IRS giving you exempt status. You apply electronically now, but it still can take 5 to 9 months for them to process.
Got it.
Okay. So Brett, anything else that you're talking about with your clients year end?
No, I think the biggest thing is just risk. I think if somebody is charitably inclined, they can use that as a huge benefit in reducing risk. With the market doing what it's done over the last 6 to 12 months, a lot of people have an imbalance in risk in their portfolio. They may own a lot of tech now. So using their charitable intent to help rebalance a portfolio and mitigate taxes is really, all around a huge benefit. And so that's really what we're finding is clients that want to rebalance a portfolio, let it be either an IRA money or trust money. We're looking at it and saying, okay, where can we, make the charitable contribution we want to make, but do it in a way that we can reduce some of the risk. And that's really kind of the focus right now. And then hopefully getting some guidance from Congress and the Senate as to where we're going with regards to some of these taxes. I think that's the other one that I'm getting a lot of questions about and hoping to do some strategy by year end.
Yes. So I know there were some questions that were asked or submitted, I should say, in advance of this panel presentation today, and we've covered some of those questions, but we have not touched on others. So let me ask. One of the people in the audience mentioned that they're a new homeowner and they wanted some advice on tax breaks for first-time home buyers. Should he or she hire an accountant to get the most tax credits or go another route? So without providing advice, can either one of you speak to the first-time home buyer?
Yeah, there actually is a bill in front of Congress to pass First-Time Homeowner Act of 2021. It would be a $15,000 credit. That has not been passed. Don't know if it will go through before the end of the year. But I would suggest that you definitely hire a CPA and talk with them so they make sure they're looking at your escrow statement to pick up anything that maybe could be deductible on there. your mortgage interest, property taxes, all that stuff. Yeah, I think it might be a good year at least to use the CPA, and then you have something to follow going forward if you like preparing your own return to make sure you're picking up all the deductions.
Thank you. So another question that was asked was, one of the audience members is starting to plan for the future of their young family, but they don't have millions in assets. Is a living trust a better option than a will? And I'm going to relate this back a little bit to the first-time homebuyer question, in that, here in California, our probate process, which is the process for transferring title at death, is a very lengthy and time-consuming process. It's painful, I would say, for most people to have to go through the process of probate. So one of the things that we do is we create trusts called living trusts or revocable trusts, revocable living trusts. And we advise clients to put their assets into those trusts during their lifetime. And as a result of doing that, then there's no probate assets, or ideally there's no probate assets, meaning assets held in the individual's name when they die that would require a probate in order to go to their heirs or beneficiaries. And so that's how the trust helps to avoid probate. For people who don't own real estate, and let's just say maybe they have some life insurance and a retirement plan, and maybe married and have a joint checking and savings account with their spouse, trust isn't necessarily appropriate or necessary for those people. Why is that? Because retirement plans and life insurance policies are considered non-probate assets. You can use beneficiary designations to specify where you want those assets to go when you die. And a joint tenancy account will immediately pass on the death of one of the joint tenants. So if it's a husband and wife and the wife passes away and the account is a joint tenancy account, it will pass to the surviving spouse on presentation of the death certificate. But what that doesn't provide for is what happens if something happens to both of you at the same time. So in evaluating whether to invest in just wills or invest in a trust, it really depends on your assets. It depends on what you want for, let's say, your children, and when maybe you want them to receive assets. And it depends on your overall objectives. So I'm gonna quote what Brett said earlier. I'm gonna give you the attorney answer of it depends. But generally speaking, in California versus other jurisdictions where the probate process is much more streamlined and quicker, like for example, in Texas, where I'm also licensed, and I've done probates there, and it's normal and it's easy. In California, that's just not the case. So typically, if you own real estate, you're typically going to have a trust or should have a trust in California. So are there any other questions from the audience that you would like to pose to any of us?
I know that there were some questions that were submitted in advance still, and that has also been messaged to me for the panelists. One is the billionaire tax going into effect this year?
If it passes, it would be effective next year.
Okay. And then another one was, let's see, please update us on nonprofit contributions for those who file in various ways, including limits, deductibles, and other considerations.
Okay. So for charitable deductions, if things are going to a public charity, you usually get the fair market value. You would get that for cash is cash. So that would be the fair market value. Public securities, fair market value. Personal property, they would look at if that is being used within the exempt purpose of the organization, if you could get fair market value. If you go over 5,000, this excludes public stock, you would need an appraisal of the type of property contributed. Bitcoin, if your organization is accepting Bitcoin, your public charity, and the value of the Bitcoin contributed exceeds 500,000 or exceeds 5,000, you do need an appraisal on that. So that's a little different kind of changes that are happening. A lot of people think of it like it's just another cash, but it's not considered cash. Let's see. So, and then once you're able to take a deduction, then you look at what's my limitations based on my adjusted gross income. So cash, you have no limits for this year. Capital gains property, it's a 30% limitation. So there's a whole bunch of rules with it, but those are the basics that affect most filers.
And on that, Patty, maybe we could talk for a second about itemized deductions and how that works, because I think a lot of people with the SALT cap, and if somebody owns their home outright and doesn't have any loan interest, depending on how much they give, it may not have an impact on their deductions.
Yeah, that's true. Because if you gave $2,000 and you're not itemizing, but you're married filing joint, you'd be limited to $600 for 2021. So the standard deduction for 2021, married filing joint, it's $18,800. So your contributions, your 10,000 SALT limit, any other things that medical you might be able to deduct, you'd have to exceed 18,500 before you're getting a benefit. So here's where the bunching comes in, that you might want to bunch up and throw all your contributions into 1 year, or think out, well, over 3 years, I would have contributed 50,000. So I'd like to do it now. And then it's like, oh, but I don't know where it should go. Those are where you get choices. Should it go into a donor advised fund? Because you can make that decision later. So if you are single, married filing separately, it's 12,550. So your charitable contributions would need to exceed that and all your itemized deductions before you get benefit.
And so maybe I can add a little more light on that. So if somebody came to me and said, I want to give 10,000 to charity, what I would do is I'd look at the return and I'd say, okay, most people in California hit the SALT cap, the state and local tax cap. So that's $10,000. So now you're at 10,000. If you have a home and you have a loan, a primary mortgage, and you can deduct the interest, let's say it was 6,000, then it goes on top of that. So now your amount of deductions you've racked up is $16,000. So if they said, I want to put 10,000, I want to give 10,000 to charity, that means that they're at 26,000 of total deductions. That exceeds the 18,800 for married that Patty just mentioned. Therefore, they would be itemizing. And so it's just important that if they put away $2,000, well, they're better off just taking the standard deduction than trying to itemize 18,000. So it's just really important that when we sit down with clients, depending on what they want to give, that's another step in the process, is looking at what's the tax benefit. And as Patty mentioned, we may take 3 or 4 years of gifts and put it into one single year so we can get above that threshold for itemizing.
Great. The one thing that I realized that we haven't touched on is what can be done in terms of non-charitable giving. And as we all know, there's a lot of different ways that you can make gifts before the end of the year that do not entail making gifts to charities, but rather to different types of trusts, maybe even a charitable trust. We talked about defective grantor trust at the very beginning, or dynasty trust. There's a lot of different things you can do. And we are thinking about having a follow-up panel discussion about more sophisticated, and you can call them fancy, techniques that are geared at helping to minimize a different type of tax, which is the estate tax. We haven't talked too much about that, other than my mentioning that the current exemption is $11.7 million, and that that exemption is scheduled to decrease to $5 million effective January 1, 2026. But things that you can do this year that we haven't talked about are annual exclusion gifts, which are really easy gifts that you can make and don't require to be reported on a gift tax return. And those are $15,000 per donor, per donee. It used to be $10,000, and it's always surprising to me how many people still think it's $10,000, but it is $15,000 this year. And that's something really, really simple that you can do to benefit children or other people in your life that doesn't require any kind of gift tax reporting. So if there's interest in talking about much larger gifts to trusts or charitable trusts, like I said, dynasty trust, generation skipping trust, there's all sorts of fancy names out there, slats, ILETs, CRUTs, the list goes on. Please let Emily know, and we can schedule a follow-up presentation that delves into more of that fun and fancy planning.
Great. Well, thank you everyone for joining this morning and for all of you who registered to attend. And a huge, huge thank you to our panelists, Danielle, Patty, and Brett. Promises2Kids is proud to celebrate 4 decades of creating a brighter future for foster children in San Diego County. And we're able to make the impact that we do because of people in our community like you. So if you're interested in learning more about the ways you can leave a legacy, volunteer, or donate, please don't hesitate to reach out to our office or visit promises2kids.org. A survey will be going out shortly, as your feedback and suggestions for topics in the future are extremely important to us. You can also send an email to me if you have a specific follow-up question to any of our panelists, and I can connect you directly. But with that, I want to thank you again for your participation and have a wonderful rest of your day, everyone. Bye-bye.